I'm sure you've heard lots of stories about people trying to raise money for their businesses. And very often they come unstuck, but they don't know why they come unstuck. So in this video, I'm going to explain 19 reasons why venture capitalists might say no to you. Now, I've split these into 6 categories to try to group them so you can understand the structure of the problem. And they are management, products, markets, customers, sales strategy, and options. Now, there may be more, but this is enough to get worried about. And what you really need to do is almost have a tick list. And when you're making your presentation to a venture capitalist trying to raise money from him, then you really may need to make sure you've got all these points covered. So let's take a look at the first one, and that's management. The first thing they want to know is that the management is of the right quality, that they've got some really good people here, because at the end of the day, they are investing in management. And part of that will be knowing that they've got startup experiences. So they will look at CVs to see whether or not the leading members of the management have actually done startups before, and crucially, have they been successful? They may well as well want to know who's backed them and may take references from those backers as to how it all went. And they want to know you've got a really good grip of the business. You've got control of your numbers, so they'll really want to understand your reporting KPIs. Can you deliver to them monthly information which is up to date, accurate, produced quickly, and has very key metrics that they can judge the performance of the business by? When they take a look at your products, they want to know how mature your product is. Now, clearly, if you're in a startup, you are going to have your product at one of a number of stages. It could be it's on the drawing board. You may have a prototype. You may have actually sold something to somebody, but only one customer, or you may have several customers. And this is all part and parcel of understanding whether there's real demand for this product or solution that is at the core of your business. Now, in the product life cycle, what they're looking at is to see how developed the product has become. So is it at the sort of type 1A beta, or is it some product that's actually been through several iterations already, so it's already been improved upon? Because they will expect you to have a pathway going forward showing product development and improvements. And of course, they will want to know if you've got patent protection on the product. How unique is this product? How difficult is it for people to copy? And if they do try and copy it, are you protected by patents? Then they look at the market and the competition. And part of this is to understand that there is a big enough market out there so that you can actually grow to become a very large business. And within that, who are your competitors? So are you competing against Apple and Amazon and Microsoft, or is it a very fragmented market? And the level of competition is actually a good thing and a bad thing. Well, obviously, very stiff competition is difficult, but no competition actually is very worrying, because it does suggest that maybe there isn't a market for this product. So you need to demonstrate that you understand the market and the competition and how you're going to compete against them. Part of that will be barriers to entry. How difficult is it for people to replicate your solution? And I'm not talking about copying what you're doing, but I'm talking about how difficult is it for a competitor to come in with something which is disruptive and which is going to basically knock you out the market. So barriers to entry are very important. And operational stability is all about, what are your sales like? How constant is your business? Do you have a subscription model where you get sales in every month once you've made the initial sale? Or do you have very big, bulky sales, but they only happen once every 6 months? Because that sort of feast and famine pattern would be quite worrying. Customer quality is critical. They want to know that your customers are well-funded, repeat purchases, and people who, once you've established that relationship, will keep buying from you. If they're all essentially one-man bands for whom the purchase is a nice to have rather than a need to have, then they're going to be very questioning as to whether you've really got a sustainable business here. And clearly, how you build your trademark and your brand in that market is also going to be critical. Are you going to be recognizable? Are people going to pay you a premium to have your brand as opposed to some competitors' other Me Too offer? Most VCs have got their sector specialities, and within that their subsector areas where they particularly like to invest. And you really need to do your homework to make sure the people you're talking to are a fit with your business. But they'll also want to understand what's your sales and distribution within the sector. What are your channels to market? How are you going to get your product into the hands of your customers? And that might be online, it might be offline, it might be through distributors, it might be direct, but they'll really want to understand how that works. And what opportunities are there for you to diversify? Because one of the best ways to grow sales is to sell more product to the same customers, as opposed to selling more product to new customers. And I'm sure you can see the opportunities for that. We could talk as well about geographic markets and all that sort of thing. Is there an opportunity for you to go and sell your product in a diversified market, i.e. not in the UK, but in the US or in Europe or in the Far East or whatever it is? One of the critical things they will look at is when they're going in is what are their exit options, and part of that is what is the scalability of your business. Now there's a very good example here. If you're running a people-centric business like something in information technology services, you can only grow effectively as fast as the number of people you have on the payroll. If you're selling a piece of software, it's very easy to scale that because you can copy the piece of software and you can then sell it to a new customer, and the incremental cost and effort of doing that is much lower. So scalability is a really, really important factor. They will want to think about your IPO capability. Is there a possibility of floating this on the market, or are they going to have to look for some sort of trade sale, whether it's to another VC or whether it's to a competitor or to an industry buyer? So they'll be looking very closely at that. And of course, part of all that is then down to valuation, because essentially their game is buying cheap, selling expensive, and actually making money on the turn. And for early stage companies, most VCs will be looking for a 10x. They will be looking for businesses that can go to $1 billion, can become unicorns. Clearly, there are very few of those. So the valuation you're putting on your business and your expectations of how that valuation is going to grow are absolutely critical. Now, one of the reasons they may say no, and this is number 19, is simply that at this point in time, they're not seeking further investment. And you need to understand that venture capitals firms raise funds which have a life cycle. And they may well be at the point where their existing fund is fully invested or close to, and they're raising the next fund. So you need to, again, do your homework on the VC, because you're completely wasting your time if you're going to sit down and have a meeting with a VC who's no longer making an investment. Now, I've got a bonus number 20 for you. And that is, they simply may not know you. Don't forget, VCs look at something like 500 deals a year, and what they're trying to do is get deals off the table so they can screen down and screen down and screen down. And if you don't have a relationship with them, that may be the easiest way for them to turn you away. So one of the things you should be doing right from the get-go is starting to build relationships with VCs in your sector, in your area, who will invest at the state of your company, and indeed at the stage your company is going to be in a year or 2 years' time. And that relationship building is something very few businesses do, and it's absolutely critical. So there you are, 19, well actually 20 things VCs want in their investment portfolio, 20 things that VCs may use to say no to you. And if you can tick all those boxes, then you've got a very good opportunity of getting funded by a VC. But I bet you it won't be the first one you go to. If you've got any questions or you want to talk to me about fundraising, definitely reach out to me, john@jbdcollie.com. Love to talk to you, and I'll see you again very soon.